Cool. Okay. Hey guys, it's Jack. So thanks for coming. Today we are talking about promises and challenges of tokenization on the blockchain as a capital market software solution. Very long title of the workshop. Reason being, I'm in a fintech conference. As you can probably tell, I'm a crypto guy. I'm probably the only crypto guy in the entire conference. And there's tokenization of payments, right? Tokenization of data, which is if you go outside, there's a bunch of vendors and companies building in that category. But what I'm talking about today is the tokenization of financial instruments on the blockchain. So different types of, different flavors of tokenization. A little bit about myself. So let's see. Here we go. So a little bit about myself. So I am building something within the space, and I'm also an entrepreneur in residence at a VC fund called Whitestar Capital. I'm part of the digital asset fund. I'm based in New York. The reason why I'm talking about tokenization today is I previously built a company in the asset tokenization space. I wrote the first guide, really, on tokenization, which was 8 to 12 months ago. Before this, if you go on headlines, if you Google tokenization now, you'll see a bunch of headlines and product launches, etc. 12 months ago, people don't really know what it meant to tokenize. And then I wrote this pretty comprehensive guide. Fortunately, went viral, I think, aggregated impressions of 1 million across Twitter, LinkedIn, etc. And pretty widely read across the institutional asset manager space. Come from like enterprise software and capital markets background, and then just a little bit of fun fact, I'm not a conventional like developer by pedigree. I actually am non-technical by training, and before going to tech, I wanted to be a diplomat. So I speak Chinese and Arabic. So now onto the actual topic itself. So today's goals is pretty simple. I see it actually, it's my mission today to spread the news that yes, blockchain crypto is still alive, despite this only me the entire conference. But number two is one of the really interesting application of blockchain is in the capital markets vertical. So I'm going to talk about what really is tokenization. Again, it's not tokenization of data, but tokenization of assets. And then I'm going to tell you what's happening. If you Google, again, tokenization, blockchain, you see a bunch of headlines. But like what really is going on? Like who are doing what? Is it in test? Is it in production? What's the goal? And then some of the promises. Why do we even bother with this new product line or new tech, right? Does it make us more money, right? Or does it save us money? And then obviously, this is a dev workshop, so there's some interesting challenges, some problems that I want to share. So to start with, just a very quick question is, what happens when you buy a Tesla stock? So actually, I'm going to open this up to the floor. Does anyone want to have a try? And when you click on Robinhood, click buy, what happens at the back? Yes, please.
Just the title to the security is transferred. I think DTCC is the company that runs the ledger, and they transfer the title from whoever you bought it to you.
Yeah, so for the sake of the recording, this gentleman said it's when you click buy on Robinhood, the title ownership of the stock changes hands, and it's being held at a company called DTCC. So that's right. So that's obviously the devil is in the details. So what I'm about to share with you is this whole new world within fintech that I'm really passionate about, and I personally think is the next frontier of fintech. Is usually overlooked, unfortunately, by developers, by founders and builders and investors. Most fintech attention narrative has been focusing on payments and banking connectivity. And I think the next frontier is capital markets, which is the movement of assets. So what's happening at the back is you see this sort of different counterparties. So you start at the top. Let me see if there's a laser. It doesn't have one. Okay, I actually don't know how that works, but no worries. So you start at the top, you buy order, And then that get routed to an exchange. So if you buy on Robinhood, Robinhood is slightly complicated because they have, as we know from GameStop, they have an arrangement with Citadel Securities, which is a market-making firm. But basically, your order gets routed to an exchange, and then at the end of the day, or with some sort of weird arrangement, depending on where you are, it gets cleared and then it gets settled. But it's kind of archaic. It's because for historic reasons, in the past, when you buy stock, you actually have a certificate where you have a paper that says, I am an Apple stock or shareholder. So that, and custodians used to be this entity that physically have a warehouse that stores the actual certificates. And when tradings happen, usually 2 days afterwards, they will change hands of those certificates. But now, obviously, since the 70s and 80s, we've been going through different stages of digitization. So what's happening right now is a lot of these is being digitized, and that when you buy Tesla stock or Robinhood, you don't really own the stock. Rather, Robinhood partners with a custodian, which really help. Well, if you look into the ledger of the custodian, which is DTCC in the US, it's actually held under that partner entity's name, and is protected by SPIC, which is this sort of insurance scheme similar to FDIC for banking, but SPIC is for securities. So it's for brokers and dealers. So, and then a bit of a quick terminology is, you can tell to the left, there's trade execution, trade clearance, trade settlement. This is called trade life cycle in the sort of industry terminology, which is walking you through the life cycle of an asset, basically. So very similar in payments, where you see a lot of diagrams, money in, money out, walking you through. You have a debit transaction, credit transaction. How does that flow? It's kind of a similar mental model in this case. By the way, you have noticed I'm trying to bridge the payments mental models into the securities and capital markets mental model. Again, I see it as that's next frontier, and that's really high impact personally. Now, what are some pain points facing capital markets? Mostly, to be frank, it's just digitization. So you'll be surprised. There's actually still a huge volume of assets, financial assets in the world, financial and non-financial even. So from things such as collectibles, wine, art, right? These have values. These are objects of values, but they're not really digitized yet, which makes it illiquid, inefficient, etc. And then one of the core problems or pain points that the industry is trying to solve is what's called post-trade processes, which is once you've finished trading that Tesla stock, how does that, if you're a retail user using Robinhood, right, and how does the accounting or the ownership change hands? And also, when you buy Tesla stock, you pay cash, right? You need to pay, it's worth $100. Okay, you pay $100 and then you receive a stock. So it's actually slightly more complicated than payments. In payments, you are transferring money from party A to party B. But in capital markets, very often it's you pay the cash to party B, and then party B has a commitment or has an obligation to pay you the stock. So this is, in traditional world, it's called DVP, delivery versus payment, settlement process. And one of the sort of core pain points that the industry is trying to work on is moving from T+2 to T+1 or T+0 settlement. And obviously, as a whole, as the entire industry is facing this cost pressure, which I think is kind of different from the motivation you see in payments, right? Motivation you see in payments is very often revenue-driven. How can we serve, bank the unbanked, right? Target new verticals, et cetera, et cetera. Capital markets, there's a bit of motivation to say, okay, this is a new asset class, we want to serve them. But a lot of times it's about back and mid-office operations. Can we just make it more efficient and make it software-driven? So specifically, here's a pain point for securitization. So this is a workflow. When you buy a house, you get a mortgage from your bank. It's being originated, that's the term being used, and then it's actually being packaged into a security, right? So if you watch the movies, The Big Short, right, about the 2008 GFC, these MBS, right, mortgage-backed securities. But the plumbings, the inner workings, the workflows, the counterparties involved, it's quite a lot, and it's actually quite expensive. There's different benchmark where you can compare, but I would say that if you ask the professionals that work in securitization, particularly like from front office, which invest, to mid and back office, which operates, everybody complains. Nobody loves their jobs, to be frank. And the pain points mostly is reconciliation, because very often they store data on Excel spreadsheet with like 20 tabs, and then with some macros, and then they share version because they're not using Git, right? So, and they just share this Excel spreadsheet version 900, and then they update it as cell, and then they name it version 901, and they email back and forth. And then when you send money, right, again, securities is interesting because you need to pay cash, and then you receive the security, right? So the two legs are separated. So when you send cash, you need a bank account. You need you need a wiring instruction. Again, that's email, that's PDF, that's printed, that's wet inked signature. So that's one pain point. Now, the reason why I want to situate these kind of pain points into this broader landscape of how I see fintech is moving forward. I think fintech, the OGs like PayPal, to a lesser extent maybe Stripe, but obviously now payments there's still a lot of pain points being solved. But if you look at the frontier of fintech adoption, software eating finance, it started with payments, which is the movement of money as a singular unit, and then it moved to Plaid, which was the movement of data in and out of bank accounts, which one bank account is an object that holds money, right? And it turns out that actually bank accounts, one person, one individual can hold multiple bank accounts, can have brokerage accounts, which holds multiple assets, etc. So the way I see this is kind of an expansion of the object of the persona that you're solving for. If you look at payments, what payments did with increasing the GDP of the internet, Plaid did with PFM and new types of fintechs, right? A lot of the software vendors or sponsors today, I think, benefited a lot from Plaid's infrastructure. I think similar things happening in terms of killer apps in capital markets, and they will benefit a lot if we improve the plumbing-based infrastructure and capital markets as well. And this is not a trend that's just boomed for the past it doesn't come out of nowhere. There's a whole trend happening. Back in 2017, this is the map of these sort of different companies in the landscape. Mostly these companies sell to asset managers or sell to financial services companies. So as you can tell, it's pretty different from your normal fintech company that sells to retail investors or sort of work with sponsor banks, right? These are more serving shadow banks, which is again, an emerging vertical of our whole macro economy. So I've talked quite a lot about the pain points. Now I want to talk about the solution. So the specific solution is tokenization, which is the digitization of financial instruments on the blockchain. And now this is going to get muddy in terms of definition because different stakeholders, different industry will still disagree on what truly counts in tokenization. But if we really numb it down, what it really means is you have an issuer of an asset. So this can be a company that may be seeking financing. They issue equity, let's say. This is the issuer. And basically, you turn this asset, you turn this instrument into a digital form, into code, basically. And then you put it onto the blockchain. Now, obviously, there's a lot more caveats and nuances. And as you can tell, this diagram is I actually pulled it out of Bank of America's research report. And throughout this slide, you'll notice that there's actually a lot of institutional adoption and talks and discussion happening, which was kind of quite counterintuitive, I think. As in, it doesn't deserve, it's overlooked, that's my point. So what's the right mental model? My mental model is tokenization is similar to having an Excel spreadsheet, which is the analog workflow, but like on steroids. So this Excel spreadsheet is 24/7. It runs 24/7. It's being hosted on a distributed cloud, right? Depending on the underlying blockchain architecture. The way to interact with the spreadsheet is standardized. So you're not going to face problems similar to the banking processor world, where you need abstraction on top of abstraction on top of core processor. Like the beauty of this is everything is standardized, and then you can have permission control as well. So like really, really interesting composability. I'm not going to go into consensus mechanism, like how does Bitcoin mining like affect this? How does Ethereum proof of stake affect this? That's, in my opinion, more a optional design choice. You don't necessarily have to. That doesn't really change the mental model. So specifically, I think actually I've been talking about like stocks and Tesla stocks on the blockchain, etc. I think that's a terrible example that I've been giving, but it's easy to understand. So realistically, what's going to happen is private assets, which are assets that are not listed, they're not certificated. So these are the companies that you guys are building, you guys are working in, right? The equity value of startups. These are loans. These are your houses. These are your mortgages, your personal loan, your credit card loan, et cetera, et cetera. These are the ones that are most inefficient, and they will benefit the most from tokenization. So what's going on now? It's that there's actually a huge explosion of the ecosystem of companies and solutions trying to solve the sets of pain points that I mentioned. So RWA is an abbreviation more in the crypto world. It's called real world assets. And obviously, the reason why it's called real-world assets is because these are companies trying to bring real-world traditional financial instruments onto the blockchain, as opposed to fake assets. Maybe if you think of Bitcoin, Ethereum, sort of more digital native. And then every week or every month, there's usually a new headline in tokenization. So there's a bunch of institutions getting involved already. KKR, Hamilton Lane, these are asset managers. BlackRock, also asset managers. JPM, which is the sponsor of the conference, they actually use blockchain for treasury repo platform. And then you also get a consortium of banks which works with a listed enterprise company called Broadridge. Again, sort of these are all in production. So we see adoption from incumbents. We also have adoption from startups. So digital assets, Corda, Figure Securitized, these are sort of from the 2017 or even earlier vintage. And collectively, they've raised, each individually easily more than 100 million plus and have multiple sort of project launches, et cetera. So this is just a case on point, like in case you're wondering, is this thing actually being used? So this is again, Broadridge is a pretty famous capital markets technology company. They have a DLT-based repo platform, which is repo is a type of financial transaction where an investor, an asset manager, a hedge fund pledge a collateral, and then they basically borrow money with it. That's the most simple explanation. It gets more complicated, but they're using this as a ledger of truth, and it processes more than 1 trillion of volume per month. So this thing is in production, and this is one example. So why even bother with like tokenization? Why even bother using this blockchain? I think a few workshops earlier, I heard people saying, I think it was Sophia actually talking about payments, saying that we don't really need crypto for payments. You can just have a centralized ledger for this. So I think I agree in varying extent. So the way that I look into this is fundamentally there's three propositions: distribution, efficiency, access. But it really, really depends on where you sit at the value chain. So this is a mental model I use, and apologies for the terrible formatting. I haven't got a group of Harvard MBAs to help me fix my pitch deck. So the way I see this capital market software or financial services software is I have this pyramid mental model. So ultimately, financial services, we're offering product and services on top of asset classes. What does it really mean? I'm an entrepreneur in residence at a VC fund. The partners at my VC fund, they offer an asset management product for the LPs in the alternatives space, because investing in startup equity, that's considered an alternative space. If you're a hedge fund, right, or actually an easier example is if you're a insurer and you're offering an insurance product on like home insurance, let's say, right? then it's insurance on some form of real estate. So you can tell. You can do different matrix and combination, and you can basically map out the entire financial services with this kind of mental model. But really, the unlock of this mental model is there's different stakeholders, different actors. So there are 4 stakeholders I think about is the issuer, again, with someone that issues a financial instrument, someone that bears the obligation, right? If you're in debt, if I'm a consumer, I'm using my credit card, like overdrawing it, I am the issuer of a consumer credit debt instrument on a more abstract level. You have the arranger or the servicer, which it's someone that coordinates a transaction, interestingly enough. It's basically an intermediary that handles the life cycle of an asset. So to give you another example, if you have a bond, if you issue a bond, you issue it, but you need someone to like arrange the investors, right? So in the traditional banking world, you get the investment banks being the underwriters. They are also the people that service the debt, or they outsource it to someone else. Servicing debt means what you need to make sure that the bond issuer is paying the interest on time, right? What's the interest rate they're paying? Maybe it's not fixed rate. Maybe it's a floating rate, right? When the Fed increases rate, they need to pay more, right? There's like 100 different bondholders. You need to distribute the interest back to them. Who manages it? The issuer is not doing it. Someone else is doing it. That's the servicing space. And then obviously you get the investors and you get the infrastructure. Investors, quite obvious, someone that holds it on a balance sheet, someone that invests, take the risk. Infrastructure, you can break it down into 2 types of infra. You get a traditional infrastructure, so that's decentralized exchanges, the CSDs, clearinghouses, CCP of the world, and you also get private infrastructure, which it's more the traditional financial services software companies. So actually FIS, FinServ, S&P, Finastra, Broadridge, these are all examples where they build walled gardens. No offense, but they do it's basically like an Excel spreadsheet. Like they build a fancy Excel spreadsheet, but in a hosted environment. And if you want to just have a sniff of the platform, you need to pay like 50K, 100K per seat, per license in order to get access to it. So as you can tell, like depends on where you sit, your motivation to care about whether or not to use blockchain differs greatly. If you're an issuer, why would you care about tokenization via blockchain? So this is super interesting. So UBS, the Swiss bank, actually tokenized, I think, 300 mil of bonds on the blockchain. And they concluded that doing bond issuance on the blockchain is more efficient. It saves them like 50 bips. And Figure, which is founded by the ex-founder of SoFi, Mike Hackney, he uses blockchain to do home equity line of credit transaction. And again, they concluded it saves like 50 to 75 bips. So for them, it's efficiency. For them, it's so for them, it's mostly efficiency. And then you also get, but these are also corporates, right? These are corporates. You get fund managers coming in, right? So KKR, Hamilton Lane, Apollo, right? These are private equity firms. Franklin Templeton, very large ETF provider, Fidelity, etc., Wisdom Tree. They are all launching funds on a blockchain. Why do they want to do it? It turns out that they concluded, they want wider distribution network, so they want to sell the products to maybe it's younger investors like people in this room, right? We don't really like calling our wealth advisors and say, hey, can you get this fund for me? We don't really do that. We just hopped on our iPhone, log into our app, and then we invest, right? So that's the story over there. And then arranger servicer, it's efficiency, right? So think about the mortgage servicing space, for example. When you pay your bank mortgage, who at the back collects the payments, make sure it's on time. If you don't pay on time, it's going to give you a penalty, right? And then distribute these interest payment back to the holders of MBS. That industry, it's pretty big, from both human contracting, and also software. Large portion of it outsourced to Bangladesh, Vietnam, Mexico, etc. But it's a margin compression story, right? These companies want to save margin and say, if we can use smart contracts and automate this, super interesting, we can make more money. So To be frank, these kind of tokenization stuff have been tried in 2018. If you remember 2017, there was ICO, bunch of different pump and dump and scammy blockchains. 2018 was security token offerings, trying to tokenize real estate, tokenize wine. So why is it different this time? In my opinion, I think it's because a lot of the infrastructure and commercial use cases are already here. In 2017, people only care about Bitcoin and don't really thought the whole about like how do you build the infrastructure for what if you lost your keys to Bitcoin? How do you do compliance? How do you represent derivatives on a blockchain, right? Now it's a lot easier to do it because of Ethereum, different types of layer ones. There's a whole different tooling surrounding it. The commercial use cases, I mean, I've given a couple of examples, right? There's a reason why the large institutions are launching funds on the blockchain. There's a reason why corporates are issuing bond, getting financing from the blockchain. So it's mostly that. Now, however, it's actually just 70% there. So this is a diagram from Bain. It's more about the entire financial market infrastructure and what are the different steps. The way that it maps onto the blockchain doesn't really map perfectly. So I'll talk about more of this later. So I've talked about like mostly the stories about efficiency, right? But there's actually two killer use cases I'm going to quickly talk about. The first one is cross-border security settlement. So I recently moved to the US. It actually is a pain to get a bank account number one and to buy US stocks without having a US bank account, US brokerage account, et cetera, et cetera. I need to go back to my Hong Kong stockbroker. It takes like 2 days for fiat funding, T+4 for settlement, and then T+7. After 7 days, it shows up on my dashboard for P&L and stuff. If I bought GameStop, I'm going to get wiped out in those 7 days. So, and cross-border security is not just a retail problem. It's a pain point, similar to cross-border payments, right? It's a pain point. But it's an even larger pain point for asset managers and capital allocators. That's one. Number two is cross-asset composability, which is the ability that because the ABI docs are open, because this ledger is open, you can basically write code on top of code, right? You can write code wraps another code. You can have a base asset. You can have a Tesla stock, right, as a base asset. You can have derivatives on top of it, which points to that asset, right? You can, I don't know, like pair a Tesla stock with a Tesla bond. You could create a portfolio and then you trade it as one. It's actually very similar to what ETFs did in the 90s and 80s to mutual funds. So there's a reason why all the large financial institutions that are in tokenization right now, they themselves are the ETF issuers. BlackRock, WisdomTree, Franklin Templeton. They saw history is repeating itself. So I realized actually, I'm going to quickly glance over this layer of the stack, like how does it actually work in terms of a technological level. Actually, I'm going to show you this, the real asset stack. So when it comes to tokenizing a financial asset, it's like a 3-step process. So we start, and my apologies for this diagram being quite small, but really it starts on the left, which is origination, which is you pick an asset you want to tokenize, you want to issue, you want to digitize. And then it goes through a digital transformation, and then you distribute it to sell it to someone else to hold it. Now, specifically, the digital transformation, the middleware, it's multiple layers of stack. The first layer is how can you bridge information and data that's not on the blockchain? How can you bring it to the blockchain? So that's where you have things like asset data, performance data, right? Maybe it's PII. There's the ownership data, which you need to track with government record. It's pretty complicated if it's real estate, for example. If you want to sell a home, it's not that simple. But if it's stock, if it's bond, et cetera, there's different workarounds. It gets easier. And then the complexity arrives. So there's different forms of smart contract standards, which is so what I'm showing you is the Solidity code, which is this JavaScript Python hybrid for coding on Ethereum, a layer 1, it's a type of blockchain. And there's different library, right, where you can represent the life cycle of an asset. And they are interoperable, but kind of not really. And then it gets more complicated because you get the banks themselves, which have their own library. and they are doing things sort of in their silo. And so it turns out that translating financial primitives into code isn't as easy as it seems. And this is actually what really excites me. Like in payments, you're usually moving money and it's money just bits, right? And there's not really, it's fairly one-dimensional. But when it comes to asset moves and asset changes over time, and asset points to something in the future, right? It's an obligation in the future, or it points something in the past. And it can also be like many-to-many, end-to-end relationship. So it's difficult, but obviously, it's pretty interesting. So there's a couple specific pain points. Number one is what I call DVP, right? So I shared this with you earlier. If you pay cash, when and how do you receive the share back? How do you reconcile, right? You need to force everybody to look at the same ledger. So it's a commercial pain point sometimes. Compliance, I think there's a lot of misconception about blockchain at the moment. It's being used for hackers, being used for gambling. Okay, well, I mean, the stats are there, but hey, that's like maybe 1% of the use case, right? 99% is actually pretty useful. And then there's edge cases, right? What if your crypto wallet or whatever gets hacked? You need a way to recover the assets. The beauty is you can actually just build it in code. So it's actually quite simple. It's not as difficult as people think. And then number two, which is the complexity, is that you need to maintain both the fintech and the crypto stack because you're basically running two ledger kind of. So there's the onboarding stack, there's the monitoring stack, and I'm just zooming in on like the compliance tech stack, right? If you put assets on a blockchain, what are the legal implications for that? It gets pretty complicated, and I can also talk about like there are pain points for different actors. So if you look at this whole life cycle, this is specifically for funds, which is if you launch a PE fund, if you launch a VC fund, or mutual funds or ETFs on the blockchain, just an investment vehicle, right? How is it being done? It's some of the layer of the stack will be on Web3 on blockchain. Some will be Web2. Some is even worse. It's like Web 1.5 software in the 90s. There's like no interoperability. Some of them they don't even have API docs. Maybe even not webhooks. Probably it's SFTP or actually you just have to web scrape sometimes. So what are the challenges specifically I care about? So here's what I think is happening, which is if you go back to the four stakeholders, right? I think there's a lot of talks among the issuers, like serving for pain points for the issuers, serving the pain points of the arranger and the servicer. I think we're missing in terms of solving the pain points for investors and infrastructure. So the reason why is similar to payments, right? When you send money, do you care if it's ACH, if it's RTP, if it's SWIFT, if it's... no, you don't. You don't care the rail. You just want it to work, right, with a set of criteria, obviously. So it's a super similar thing in capital markets. Investors don't care about the rails. They don't care if you're buying a stock, Tesla stock, if it's via the Robinhood, the DTCC, the traditional route, or if it's on the blockchain. So all they care is number one, risk and return. So what am I buying? Am I buying Tesla stock? Am I buying some shitty asset? That's what they care. Am I going to make money from my investment? That's what they care. Now, if it's on par, if you have Tesla stock on a blockchain, Tesla stock via traditional world, completely on par risk and return, then the next thing they care about is the tech and operations. But it gets a little bit muddy. Super similar to you guys selling to banks, right, or selling to fintech. The front office people, the sales and BD people, they'll be like, okay, I want this. And then they're going to kick the can down the road to the operations and back office people to sort it out. Even worse, in asset managers, it's not that tech-driven. So the tech and operations gap is something that I'm pretty passionate about, which is how to reduce that gap, which comes in the forms of interoperability, in the forms of how can we reduce the risk of interacting with a blockchain. And then once we fill out that gap, there's like additional benefits that I talked about of using blockchain as a transfer of assets. Composability, cross-border issuance, the fact that you can issue an asset on a blockchain and it's zero cross-border. You can have Brazilian investors trying to buy this. You can have American investors, Chinese investors. That is pretty revolutionary. But we need to fill out that gap, that tech and operational gap, and then we can make use of the additional benefits. So this is my point, which is it's something that I will publish pretty soon. It's a onboarding guide for institutions to digital assets. This is a specific workflow for a crypto native fund that wants to trade on DeFi. Now, this is not catered for like tokenized assets. So these are trading, Shiba token, I don't know, like useless crypto tokens, basically. It's meant to be provocative. And the UX sucks. Like they stitched together like more than 10 to 15 tools just to be able to run a crypto fund and to interact with the blockchain. So fast forward in the next 12 months, what's going to happen is there's going to be a lot of action in terms of a lot of headlines and product launches for people to launch products on the blockchain, to issue tokens that represent real-world assets. And we're going to end up with scattered islands where there will be a lot of pain points for what we call the front to back office setup. So your traders will be looking at one ledger, your accounting will be looking at another ledger, your operations people will need to reconcile, will need to sort out the routing, the compliance, the logic. This sucks, right? And it adds to the fact that there's so much design choices. Like you can issue an asset under a particular jurisdiction. You can choose for the fixed income, for the bond example, right? You can pay the interest on the blockchain, or you can pay it off-chain. You can pay it, do it at ACH. What about the logic? Like, how do you deal with the logic? Like, is it on the blockchain, or do you have like put it on a database somewhere, host it somewhere, and then you need to design like separate API docs to see the logic, to verify that the interest rate calculation is correct, right? A lot of it's pretty messy, but these create opportunities. So the opportunities, I think, is that the future of capital markets is developer first. So what's happening right now in status quo on the left is you have this front office, middle office, back office setup, right? So front office are your investors. If you go on YouTube or if you go on like Twitter and you look at the stereotypical hedge fund bros, the traders, they are the front office, right? And a lot of asset managers, they hire quite a lot of middle office and back office. And what does that remind me of when I was thinking about this? This reminded me of payments and banking in the past, right? These two subverticals that fintech had pretty good traction. It's a long journey, but fintech, I think, has made really interesting impact. Payments in the past, 20 or 30 years ago, you used to have to talk to a banker in suits, right? Which can be a front office or a back office person that manually reconcile ledger, But now it's developers. Now we have a developer conference for payments and banking. Exactly the same thing. I think in the next 3 to 5 years, we're going to have another conference. We're going to have a fintech DevCon that's going to have a lot more people building capital markets. That's a future that I'm really excited about. And the reason why for that is the future of asset manager. The future of asset management is you have the front office, investors, and then you're going to hire engineers in your fund that use different tools to do the same thing as what middle office, back office have done. This has already happened in the best trading firms in the world. Citadel, D. Shaw, Jane Street. These are super tech-driven, but this trend is going to trickle down into the majority and the median of asset management. So I'm just going to leave you with this. If there's any takeaway, well, number one, blockchain is useful. It's just enterprise software, in my opinion. There's a lot of design choices, super interesting, a lot of killer use cases. And in order to get there, we need to build for the buy side. So build for investors because they hold capital, they choose the tech stack. And we should build with a developer first mindset, build the plumbings, and then we can enable the killer apps on this rail. So if these kind of problems excite you, we'd love to have a chat. Thank you so much.